Well, it's a very good morning from him, and of course, it's a very good morning from me. Welcome to my mortgage live stream. I hope you're well. I hope that life is keeping you safe and comfortable and rewarded, and you had a great weekend. What a great introduction! Hello. Let's go on air, shall we? Because we should show this is live and not an AI, because that's the future, isn't it? I saw at the weekend how AI, of course, can transform your image as a video and your voice as well. And it's getting so good now that you won't even be able to notice it's me or not me in the future. So I have to make sure you know it's live. Difficult to do, really, isn't it, as time moves on? But hey, good weekend. I think my sports teams did terribly this weekend. Gloucester got hammered by Bath, and Man United got hammered by Newcastle. So not particularly very good sports-wise, but we won't go into that because we're not here to talk about sport, are we? We're here to talk about mortgage side of things. And I've got some CPD for you today on tax, because obviously we're in the new tax year now. And we're putting some new videos onto our boot camps, our CMAT boot camps and things, to show you the new figures and stuff. So, you know, you're all up to date. And I've got some stuff on taxes, or my cheat sheet, as I call it, and capital gains tax. I bet you can't wait right now. But it'll be useful and interesting, and we'll update you as well. And I've got another little session on the inner game of referrals, as I call it. A little bit of psychology for you as well along the way. So without any further ado, why don't we pop over to the whiteboard and we'll make us start with our first session for you. So let's pop across there and we'll get started, shall we? All right, let's go over to the whiteboard. Let's just click on the button here and head over here. Now here I have my cheat sheet. You notice I've done this pretty much most years for the last couple of years. And it's my 4 times tax times cheat sheet. Because I've got the 4 basic taxes there, the 4 big taxes: stamp duty, land tax, capital gains tax, IHT, inheritance tax, and income tax. I just want to remind you of the numbers and just some of the key things to help you if you're doing your exam or you're just refreshing yourself, really. That's where I'm going. So let's just give you a little bit of information on these things. Stamp duty, land tax starts first. As you can see from my little picture of my little cottage, this is the one on property, not shares. There is, of course, stamp duty reserve tax on share purchase as well. Now, stamp duty, land tax, we did a video last week, so we understand the numbers. They have changed or gone back to what they were before. You've got a number of chunks or slabs in which you have a certain rate. So just taking a look at this little arrow here, the first slab I'll put in there is 125,000, so I'll put 125k there for you. The second slab is up to 250 now, so let's just put that in there for you, 250. Okay, now the numbers here, of course, it's 0% on the first slab, which is nice, but how many properties do you know below 125,000? Then it goes up to 2% between the two, and then between 250 and up to 925, let's put that in there for you, 925. There you go. It's a whacking great big 5%, and then above that is 10%. Now that's for England and Northern Ireland, I believe, and the other countries have different rates, which you need to look into, of course, and find those. But that gives you a good indicator as how stamp duty works. A couple of rules for you. Second homers, as I call them. Now, these aren't the cartoon Homer, of course. Second homers are plus 5% now. So if you're buying a second property, not your second home, you know, you've bought one, sold one, buying your second, not that, you're buying another home for whatever reason, another 5% gets slapped on, which is horrendously expensive. First time buyers, FTBs, there you go. They now, of course, can get no stamp duty on the first 300,000. There you go, 300,000, which is key for them. So it's a little bit of a saving there, isn't it, for first time buyers? And as I mentioned to you, in Scotland, which we're going to move to at some point, which looking forward to, and Wales, of course, they have their own figures, which you just have to know what they are. They're easy Googled, aren't they? Not a difficult thing to do. So that's stamp duty. Okay, keep it flicking over nicely. Over to capital gains tax, payable when you buy an asset and sell it and you've made a profit. So typically it's an investment such as stocks, shares, unit trust. It could be a second property, for example. It could be gold, anything that you're buying, antiques that makes a profit for you. Now there's now, thankfully, just 2 rates of capital gains tax. Basic rate taxpayer, so your BRT, basic rate taxpayers, are now charged at 18%, and high rate taxpayers, HRT, are now charged at the princely sum of 24%. So, pretty hefty. Gone up, of course. They used to have an extra percentage for people selling second properties, but that's now been incorporated into the two rates there for you. You have an annual exemption. Your annual exemption now is 3,000. Was that last year as well? Which means you can make a gain of £3,000 and not pay capital gains tax. And that's it, really. Pretty simple. Think about it. They simplified it quite nicely, didn't they? All right, over now to income tax, which we did a video for you a couple of weeks back on income tax, or we're going to be doing one for you moving forwards. The rates haven't budged at all. They're still the same. You have a personal allowance. Let's put that in there for you. A PA, a personal allowance, is still 12,570, odd figure. They've got this thing called fiscal drag, which means that they ain't changing the bands. So everybody whose salary goes up each year by 3 or 4% or whatever, you will start to find yourself into high rate tax. You'll start to see your personal allowance being eroded because your salary is going up, and these bands they're not budging for, well, they reckon till the end of the decade. So there can be so many people at high rate tax. So what is high rate tax then? Well, there's three bands of income tax. I'll put them in my little bucket. This is my little bucket here. This is where your salary pours into. 37. Let's put that in for you. £37,700 is the basic rate band. So just to put that into context for you, if you earn 50 grand, for example, 60 grand or whatever, the first 570 is tax free. Nice. Then the rest of it up to 37.7 is taxed at 20%. So that's tax free 0%. Let's put that in there for you so you know what that means. That's at 20%. Any income you earn over the 12,570 plus the 37.7 is then taxed at 40%, high rate tax. That's the high rate taxpayer. And that is capped at one, it's an odd figure, is it 125? Just check the figure for you, 140. That's an odd figure, isn't it? And above that is then at 45%, which is additional rate tax. So ART, high rate tax, and basic rate tax, BRT. Often here see those initials. Fine, not much more to say about that. And that's the taxation, which we can work out some numbers next time. Now there are some allowances here as well. I've got the personal allowance there for you. You've got the savings allowances now. Savings allowance, PSA, personal savings allowance is known as, which gives you an amount of interest you can earn without paying tax. This ignores ISAs, of course, which are tax-free anyway. Now, if you're a basic rate taxpayer, BRT, there you go. Sounds like a burger, isn't it? Well, a BLT, isn't it? Then you can have a grand, 1K. If you're a high rate taxpayer, then you can have £500 of interest payable without having tax paid. Additional rate taxpayers don't get it. So that's income tax. Again, this is a cheat sheet for you, giving you some ideas about the numbers. Let's get on to inheritance tax now, which is all the press, all the changes with pension pots now forming part of somebody's estate. So a lot of people now are getting rather worried about inheritance tax if they've got big pensions. Now, the great news is, of course, with inheritance tax, is that whilst you're alive and in your will, you can shed your money, shed your wealth, and give it to people. How cool is that? Now you can therefore do gifts. So let's just put in there gifts. You can gift things. Now there's two types of gift effectively. There's exempt gifts, which I'll put down here in a second for you. And there's potentially exempt gifts. Good phrase to use, really, isn't it? Now, the potentially exempt gift is known as a PET, which is another acronym, potentially exempt gift. Well, potentially exempt transfer it stands for, because they call it transfers, where I call it gifts. Yeah. So what you're doing here is you're giving money away. You're giving your assets, your wealth to people before you die, and therefore you don't pay inheritance tax. Now, exempt gifts, there's loads of these. You can give money to charity, you can give money to your spouse, you can give small amounts of money, which is the cheat sheet here. You can give £250 to as many people as you can, as long as you've got lots of friends. You can also give £3,000 a year to one or more people. It's not a lot, is it? £3,000. These numbers haven't changed for years. In the event of a marriage, you can give £5,000 as a parent. As a grandparent, you can give £2,500 away in wedding gifts. So there's lots of these exempt gifts and amounts that you can give. Political parties is another one, for example. You can give your assets to the public good so they can display them. That's why the National Trust has got so many properties on its books. But potentially exempt gifts, transfers, that's the 7-year rule. So you can give as much as you want to somebody, maybe your children, but you have to live for 7 years. Hence, I've got this 7-year rule here. Live for 7 years. What that means is if you die within the 7 years, a proportion of that gift is actually liable to inheritance tax. And it works by 3, 4, 5, 6. And in the first 3 years, if you die, 100% of the gift is liable for inheritance tax. Even if you're dead, obviously, but you die within 3 years of giving it, they add it back on. Now, as you live longer, the percentage goes down 80, 60, 40, 20, and then nil. At the end of 7 years, the gift is completely wiped from your estate. Now, when you do die, you've got your nil rate band. Let's put that in there for you. The nil rate band is how much of an estate you can pay at 0%, nil point. And that's 325 this year, hasn't changed, which is great. And you're entitled to one of those. If you're a married couple, you can have one each. Remember, you can transfer to your spouse without incurring inheritance tax. And if you don't use your nil rate band, you can transfer that to your spouse too, and they can have 2 of them when they eventually die. There's also the residence nil rate band, which is for your main residence. If your main residence is in your estate and it's below 2 million, you can actually have an additional 175 of nil rate band, effectively giving you 500,000 or 500,000, as you can see, gives you the total there. And again, that's transferable. If you don't use it, you can pass it to your spouse and they can use it. So if you die and you leave everything to your spouse, great, there's no inheritance tax. But when they die, they then leave everything to their children, which normally happens. They get up to £1 million of 0% on inheritance tax. So, it's plannable. It's plannable. And that, my friends, is my cheat sheet for the 25. Let's put a proper year up there for you. Right? So we're talking about 25, 26 tax year. And this time next year, I will probably be on here, hopefully, and do it again. See you then. Bye. All right. So good stuff, hey? Good stuff. That's the cheat sheet. Hope that's been useful for you. What I'd also like to do now is carry on the subject of taxes to keep you up to speed with what's going on with the tax change and stuff. I'm going to take a look at capital gains tax in a bit more detail with you, because there haven't been many changes to capital gains tax. A few things have come in, some of the release and stuff that you need to be aware of. So it's probably worth just picking up on these with you as well for a couple of minutes. So I'm going to head over to the same whiteboard. But obviously I need to wipe this clean, because that's what whiteboards do, don't they? They wipe clean. So there we are. Let's get rid of these. Saving the planet here, because we're not using paper, which is recyclable. The ink we use is actually recyclable too. So I'm pleased about that. So these pens that we use now are fully recyclable. I don't know how many flip chart pens and whiteboard pens I've chucked in landfill over the last 30 odd years. It's quite frightening to know, but these are fully, you just fill them up with ink like in the old days. We used to have fountain pens. What's a fountain pen? People say to me. Anyway, let's get on with the topic, shall we? Let's talk about capital gains tax. And what I want to focus on now is reducing your CGT bill. That's what I want to do. Now, we know that capital gains tax is a tax you pay when you buy something, hold on to it, and then you sell it, and you've made a profit. And that's fine. And you've got to pay at 2 different rates according to your tax position. So I've got for you what I call the dirty dozen. I don't know why I call it the dirty dozen. I think there's a film, wasn't it? A cowboy film called The Dirty Dozen. Ways of reducing your capital gains tax bill is what I want to do. So let's just give you these 12 ways of reducing CGT. Very questionable in the exam, by the way. They always pick up these questions in no particular order. The first thing you've got is you've got your annual exemption of £3,000 exemption. Not much more to say about that, really, apart from it's jolly good. So let's put a big circle around that one as well, shall we? Now, the annual exemption means that you can make that amount of profit each year, use it or lose it, and it reduces, obviously, your capital gains tax bill. Transfer between spouses. So if you want to give your spouse or civil partner, circle I read, your assets, you can. There's no tax to pay. So that's pretty good, isn't it? This is one that's a bit wrong to say, but if you actually die, so dying itself avoids capital gains tax, because if you died, your assets get put into a pot and passed over and you're liable to inheritance tax. But on your death, there's no capital gains tax payable on the growth of the asset. So, for example, if you owned a second property and it had gone up in value over the years and you died, naturally the value of that would go into your pot for inheritance tax. I get that. But there's no capital gains tax to pay by the person that inherits that property. So I wouldn't suggest that's a good way of doing it, but it's certainly something you could do. Now, on that subject then, if you bought something that it was an asset, you could then improve the value of that property or asset, and that in itself would not be liable to capital gains tax. So, for example, if you bought a second property for rent, for example, down by the seaside or whatever, and you build an extension on it, that's you putting money into the asset rather than the asset just going up in value. So that in itself is also exempt as well. Now, there are a number of exempt assets as well, so that's worthy of putting up over here. Let's put a different colour pen now. Now, we're talking about exempt assets. Now, they love this question in the exam, don't they? Which of the following is exempt from capital gains tax? And there's dozens of them, but the important ones for you, first of all, is you've got ISAs. So if it's a stocks and share ISA, that's exempt. Government gilts are also exempt from capital gains tax as well. This is another one now, chattels. Horrible phrase. Now, chattel is something that's just ancient history, isn't it? It's your bits and bobs around you, things that you own that aren't worth very much. I think the figure's 6,000 or something like that. But it's just things you have around you called chattels as well. EISs, CSIs, venture capital trusts. These are investments in high risk shares, usually in the AIM, or trusts, obviously the Enterprise Investment Scheme. VCT is the trust. So they are exempt from capital gains tax as well, which is great. My favourite one, the woodlands. If you own a woodland, you're exempt from capital gains tax. How cool is that? So I'd love to own a wood, wouldn't you? We were out walking this weekend and we saw all these bluebells. Time of year, beautiful, wasn't it? Because the canopy hasn't erupted yet and therefore the sun can get down. Very pretty. I always would love to. A lot of work involved in running a woodland, I should imagine, as well. So lots of exempt assets, really. I mean, private cars is another one as well that crops up. So lots going on. So there's a few there for you. Let's keep going. Sneak this one over here. Before 1982 is an odd one, really. Not a lot of people know about this one. It's not publicised very well. But if you owned an asset and you bought it before 1982, you can actually rebase it to that year. What that means is that they ignore the value of the asset when you bought it and they just give you the price to start with in 1982. So, for example, if you bought a property, say a second home in 1970, and it was worth like £1,000, and obviously you work out what it's gone up if you sell it now, but they would look at what it was worth in 82. It might have been worth 10,000 in 1982. So they effectively rebase it to that year, which obviously limits the amount of gain. So that's one to think about as well. Big ones for you over here. Your principal private residence. Let's just put that in there in full, shall we? Your principal private residence. There you go. So if you own a principal private residence, that doesn't have capital gains tax attached to it. And that's just the way it is. It makes sense if you think about it, because your home is for your family, isn't it? And we have a home here and everybody does, and there's no capital gains tax to pay. If you let out your property at any point, there might be a liability for some capital gains tax for the period where you let it. If you get a lodger in, that's usually exempt, with the lodger allowance and stuff. But your principal private residence, broadly speaking, is exempt from capital gains tax. Now, your second property, though, isn't. So let's just quickly look at this area. If you have a second property, multiple homes. So if I put in there a multiple homes. Now, I'm talking here about multiple homes here. Slightly different, you're probably thinking, because if you had a second home which you bought for rent or you bought to holiday let or something like that, that's always liable to capital gains tax, because it is. As soon as you rent a property, the revenue feel that that's an asset now, not where you live. But if you've got a multiple homes, so for example, the MPs. Now, our MP came around to see us this weekend, old Max. Decent guy. He's a Liberal Democrat, and he's got a home here in Cheltenham. And I believe he's got a flat in London, because he's often at Parliament, and he has to have this bolt hole in London, which he goes backwards and forwards. Or it's not a million miles away, so he may well commute. But if he has two properties, they're effectively both his homes. He doesn't rent either of them. As soon as you rent a home, it becomes liable to capital gains tax. But if he goes from one home to another because of his work, and some people do, and no knocking it, Max is just an ordinary bloke. He's not loaded or minted, he just has a job over there and a job here. So what he can do is he can decide within 2 years to nominate which home he wants as his principal private residence. So what I'm saying here, just bring this and down, is if you've got multiple homes, you choose which one you want to nominate as your principal private residence. And as long as you do that choice within 2 years, then the revenue, you flip them, as they call it. You flip from one home to the other. Now, I don't have that problem. Maybe you don't either, but it's a problem that a lot of people do have. Okay, a few more ways of reducing it. Losses is the other one. Yeah, losses. So if you make a loss in any one tax year, you can offset that loss against the gain on something else. So a good friend of mine years ago, he was investing in unit trusts and all those sort of good things at the turn of the century, and he inherited some money, a couple of 100,000 if I remember rightly. So he put it in unit trusts, investment trusts in the IT sector on the turn of the century. So that's 25 years ago. You have this dot-com bubble went burst after the new year or the millennium. And he lost a load of money. He lost about 60, 70 grand on paper. He didn't sell his investments, but they went right down. Then he was going to sell, I think it was a property at some point in the future, where he'd had this big CGT bill due. And I said to him, what you can do is offset the losses against this big bill. So he did that. He sold his unit trusts that tax year, revealed a loss. He then bought them back 30 days later, which you can do, which was great. So this loss was revealed in that tax year. He then offset that loss against the gain he made on the property, and he ended up not paying any capital gains tax. So well done him. Now, losses can be carried over year after year after year if you don't use them. So they're well worth thinking about as well. That's your losses. A couple of technical ones now for you. Let's just bring these in for you. These are pretty straightforward. We've got a couple of technical ones. One down here I call the business. So we're talking here of businesses here, aren't we? As opposed to individuals, called rollover. Business rollover. Now, business rollover is where you have assets, in a business, which you can sell and then roll over to buy new assets. So you sell a bit of equipment and buy another piece of equipment, and you're effectively deferring the capital gains tax until eventually it's sold for cash. So that's called rollover. You've also got holdover. These are very similar, aren't they? Business holdover. Now, again, this is business and assets as well, where you pass these assets on to recipients and you defer the capital gains tax until they sell the assets. Again, it's to do with family businesses mostly. This one's rolling it over to another asset. This is holding it over, so you pass it to somebody else, some other recipient, a son, for example, and he or daughter, and he or she then holds on to it, and they'll sell it eventually. So you're deferring capital gains tax in both those situations, which is pretty cool, isn't it? The other one for you is BADA, as it's known as. BADA is business asset disposal relief. So let's write it in there for you because it's quite complex really, isn't it? Business asset disposal relief. Now, let's get this into context. Holdover, remember, is where you are effectively holding it over, giving it to somebody else, not paying CGT. They look after it. When they sell it, you're holding over the bill. Agricultural relief comes into there as well. A business rollover is where you effectively sell your asset for cash, but you immediately buy another asset, an upgrade, if you like. Whereas this one, BADA, is where you literally are selling your business, for example, selling the shares of your business, and you're disposing of a business asset. But because it's a business asset, you get a reduced capital gains tax, which is pretty good, and it's 14% for this year. It's going to go up to 16% in a few years' time as well. So it is increasing, maximum 1 million as well. So there is a limit to what you can do. They used to call it the entrepreneur's relief many years ago. I think that was a better name for it personally. They changed it now to BADA, which sounds awful, doesn't it? It just put the rings around these things. So you have to get your head around those kind of business reliefs as well for you. So there's quite a few exemptions there for you, isn't it? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 ways of reducing your capital gains tax for CMAP. If you're studying beyond CMAP, you need to dive into these things in a bit more detail. We've got videos for those things, particularly on our DIP FA courses as well. I hope that's been useful. Bye. All right. Quite detailed today, wasn't it? But useful, hopefully, in your studies and your CPD and all those good things. So as always, let's now finish off, if we can do, with little kind of, I don't know, in a gamey kind of way of helping you in your business, a soft skill, as we often call them, a communication skill. And this one's to do with attitude or beliefs. And I call this one the inner game of referrals. Now, the inner game of referrals is literally that, self-belief. It's all in the head. Now, as professional advisors, we pride ourselves, don't we, on doing an extraordinary job with our clients. So why don't we ask every client for an introduction or a referral? Here's why we don't. Now, last month, I was working with a group of professional advisors, and I made the point that referrals are crucial. In response, I received a wave of eye rolls and a consensus. Of course we do, Paul. Of course we do, Paul. So I then asked them if they actually asked every client they ever met for a referral. And suddenly everybody broke eye contact with me and looked down. So I asked them, why not? And they replied, it feels weird, Paul, or it makes the conversation go weird, or it feels too salesy, or I feel like I'm begging them for something. It never seems the right time to ask. So loads of responses. And my conclusion, though, is it's all in the head. Question away those beliefs and you'll turn on your referral management system. It's not difficult to ask. It's just difficult to convince ourselves sometimes. Remember, sales are 95% psychology and 5% in the head. I hope you found that useful. There we are. Just makes you think, doesn't it? Okay, time to wrap up. We've been running for half an hour today, haven't we? So let's wrap up, shall we? And look forward to seeing you again next week with some more angles on CPD and mortgage and all those good things. As always, if you get the chance, do head over to our system so you can log on to our portal. There's the QR code, which I always give you, don't I, which gives you the information that you need. Other than that, I wish you a fantastic week ahead. Enjoy yourselves, have fun in the sun if it decides to shine, and I'll see you all next week. Bye.